Hello, this is Really Han AG. Let's go start video silver investors. Something just shifted beneath the surface of the financial system, and most people still have no idea it happened. You won't see this leading mainstream headlines yet. No breaking news banner. No panic across financial TV. But underneath the calm surface, cracks are widening, and the signals coming out of the bond market and the Federal Reserve today suggest that we're moving into a very dangerous phase for the global economy. This isn't some long-term theoretical discussion about what might happen in 5 years. This is happening right now. Today's moves matter. And if you understand them early, you get positioned before everyone else realizes the ground has already moved. Because what we're seeing now is the Fed stuck in a corner, the debt machine running out of room, and markets quietly preparing for a shift that most investors are still not ready for. And when systems get trapped like this, money starts looking for safety. Not hype assets. Not speculation, real protection. Historically, that's when gold and silver stop behaving like boring metals and start behaving like financial lifeboats. And that's exactly the setup we're walking into. What just changed? And why today matters. Let's slow this down and walk through what actually changed. For months, the Federal Reserve has been repeating the same message. Interest rates need to stay higher for longer. Inflation came in hot after the pandemic, and the Fed responded with the fastest rate hikes in decades. The goal was simple: crush inflation even if it meant slowing the economy. But markets don't just listen to what central banks say. Markets watch what reality forces them to do. And here's the problem. The economy cannot handle high rates forever. Consumers are already stretched. Credit card balances are hitting records. Mortgage payments are painful. Companies that borrowed cheaply during the low-rate years are now facing refinancing at much higher costs. Governments are rolling over debt at interest rates they haven't had to deal with in a long time. So even while the Fed talks tough, the bond market has started whispering something very different. Investors are quietly betting that rate cuts are coming in the future, not because inflation magically disappears, but because economic stress eventually forces policymakers to change direction. And the clearest evidence sits inside something most people never look at: the yield curve. The yield curve warning signal. The yield curve is simply the difference between short-term and long-term interest rates. Normally, long-term loans carry higher interest because of risk over time. But when markets think trouble is coming, short-term rates end up higher than long-term ones. That's called an inverted yield curve. And historically, it has been one of the most reliable recession signals in modern financial history. For months now, the yield curve has been deeply inverted. That inversion signals economic stress building underneath the surface. But now something important is happening. The curve is slowly trying to move back toward normal. Most people would assume that sounds positive. It isn't. Because historically, the curve uninverts right before or during recessions, when the Fed begins cutting rates to respond to economic weakness. In other words, the market is saying the slowdown is coming. And today's bond market moves, combined with fresh Fed messaging, reinforce that idea. Inflation isn't fully gone. Growth is losing momentum. And policymakers don't have an easy solution left. They're walking a tightrope where every choice damages something. Raise rates too long, and the economy breaks. Cut too early, and inflation and currency confidence suffer. There is no painless exit anymore. And whenever central banks reach this point, investors begin quietly preparing for policy mistakes. That's when safe haven assets wake up. When metals stop acting like metals in calm economic environments, gold and silver often move slowly. They trade quietly compared to tech stocks or crypto. Most people ignore them because they don't feel exciting. But during periods when trust in monetary policy starts to weaken, these metals suddenly take on a completely different role. They become insurance. Investors stop asking, "How fast can this go up?" and start asking, "What protects me if things go wrong?" Because when policymakers are forced into bad choices, currency value usually pays the price. And purchasing power, once lost, almost never fully comes back. That's why moments like this matter. Not because of one day's market move, but because of what the setup implies going forward. And the uncomfortable truth is that the Fed now finds itself trapped by forces it helped create. That trap is what we need to understand next, because it explains why the next few years could look very different from the last decade. And once you see the box the Fed is stuck in, silver's role in the coming cycle becomes much clearer. The Fed's impossible position to understand why this moment matters so much. You have to understand the position the Federal Reserve has slowly boxed itself into over the past few years. And the truth is, this situation didn't appear overnight. It was built step by step through years of cheap money, emergency stimulus, and debt expansion that kept the economy running but also created long-term consequences that are now coming due. Think about what happened after the pandemic shock. Governments around the world flooded economies with money. Interest rates were pushed to near zero. Borrowing became incredibly cheap. Companies borrowed aggressively. Households refinanced mortgages. Governments issued massive amounts of debt to keep economies alive. At the time, it worked. Markets recovered. Growth returned. Asset prices exploded higher. But the side effect was inflation, and once inflation took hold, the Fed had to slam on the brakes. That meant aggressive rate hikes. And those hikes changed everything. Higher rates hurt more than people expected when interest rates rise. Borrowing becomes expensive across the entire economy. Suddenly mortgages cost more. Auto loans cost more. Credit cards cost more. Corporate loans become harder to manage. Government debt servicing becomes heavier. And here's where the trap forms. The United States government, along with many other countries, is now carrying enormous debt loads. Trillions of dollars of that debt constantly matures and has to be refinanced. When rates were low, refinancing wasn't a problem. But now bonds are rolling over at much higher yields. Every time that happens, interest payments explode higher. And that interest expense has to be paid somehow, either through higher taxes, spending cuts, or more borrowing. And politically, governments rarely choose painful austerity. They borrow more. So the Fed faces a brutal dilemma. If they keep rates high to ensure inflation stays under control, debt servicing costs surge. Companies under pressure start laying off workers. Bankruptcies rise. Unemployment climbs. Financial markets feel stress. Political pressure intensifies. But if the Fed cuts rates too early to ease that pressure, inflation risks reignite. The dollar weakens. Investors lose confidence in the currency, and prices begin climbing again. Both paths cause damage. And that's what it means when analysts say the Fed is trapped. Every option now comes with consequences. Debt is the silent pressure building underneath. Most people watch stock prices to judge how the economy is doing. But professionals often watch debt markets more closely because debt tells you how sustainable growth really is. Right now, debt pressure is building in several places at once. Corporate America borrowed huge amounts during the cheap money years. Many companies pushed debt maturities into the future, assuming rates would stay low. But now, as those loans come due, refinancing costs are much higher. Profit margins shrink. Hiring slows. Risk increases. At the household level, many families are juggling mortgages, car payments, student loans, and credit card balances, all at higher interest costs than they expected a few years ago. Consumers can handle pressure for a while, but eventually spending slows. And when spending slows, economic growth weakens. So even if inflation cools somewhat, the damage from higher borrowing costs keeps working through the system with delays. The Fed knows this. Markets know this. That's why bond investors are increasingly betting that rate cuts eventually become unavoidable, even if inflation hasn't fully disappeared. The bond market's quiet message, while headlines focus on stock market rallies or daily political drama, bond markets are sending a quieter but more important signal. Certain bond yields have stopped climbing and are beginning to stabilize or roll over. That suggests investors expect future economic weakness, forcing the Fed to shift policy. At the same time, the yield curve's deep inversion is beginning to unwind slowly, a pattern that historically appears right before recessions begin. It's as if the bond market is saying, you can talk tough today, but eventually you'll have to cut rates because the system can't carry this load forever. And once investors widely believe that future money will become easier again, confidence in long-term currency value starts getting questioned. When that happens, money begins moving toward assets that aren't tied directly to government promises. Gold and silver start getting attention not just as trades, but as exits from monetary risk. Why this matters for silver investors, here's the key point silver investors need to understand. When central banks lose flexibility, volatility increases. Markets stop moving smoothly. Confidence starts swinging between fear of inflation and fear of recession. And silver lives right in the middle of those forces. It reacts both to monetary stress and to economic cycles because it sits between being a store of value and an industrial metal. So when uncertainty rises, silver doesn't move calmly. It moves violently in both directions. That scares short-term traders, but long-term investors recognize something important. Volatility creates opportunity if you understand what you're holding. And right now, the forces creating that volatility are getting stronger, not weaker. But the debt side of this story goes even deeper because the scale of borrowing now makes future policy decisions even harder. And once you understand how unsustainable the debt trajectory has become, the bigger picture for precious metals starts to look even clearer. The debt spiral nobody can stop. To really understand why markets are getting nervous beneath the surface, we need to talk plainly about debt, because debt is the silent engine driving almost every economic decision right now. And the truth is, the system isn't just carrying large debt. It's carrying debt that keeps growing while becoming more expensive to maintain. For years, low interest rates allowed governments, corporations, and households to borrow cheaply. Debt didn't feel dangerous because servicing it was easy. Payments were manageable. Growth covered the costs. But that world changed when rates surged. Now, the same debt has to survive in a high-rate environment. And that changes the math completely. Why debt costs explode over time? The United States government already carries tens of trillions of dollars in federal debt. That number alone is massive, but the real issue is the interest cost attached to it. Each time older bonds mature, they must be replaced with new bonds issued at current interest rates. When rates were near zero, this refinancing process barely hurt. But today's rates are far higher. That means every rollover increases annual interest expenses by hundreds of billions over time. And those payments don't build roads or fund innovation. They simply pay interest on past borrowing. So the government has three options: raise taxes, cut spending, or borrow even more. Historically, governments choose more borrowing because it's politically easier than austerity. But borrowing more eventually leads to money creation or policies that weaken purchasing power. And that's where hard assets enter the story again. Because when currency value erodes slowly over time, assets that hold real-world value start gaining attention. Debt pressure is everywhere. Not just government. The government isn't alone in facing this pressure. Corporate America is dealing with a wave of debt that was originally issued when rates were cheap. Many of those loans mature in the next few years. Refinancing them now costs significantly more. That squeezes profits. Companies respond by cutting costs, freezing hiring, or laying off workers. Then there are households. Mortgage payments for new buyers are dramatically higher than just a few years ago. Car loans cost more. Credit card balances carry record interest rates. Student loan payments are restarting for many borrowers. Consumers can handle pressure temporarily by dipping into savings or using credit, but eventually spending slows. And when spending slows, economic growth weakens. So even if inflation numbers look better, financial stress keeps building quietly underneath. This is why markets increasingly believe the Fed won't be able to keep rates high indefinitely. The debt math simply becomes too heavy. The truth about inflation: it never really left. Here's another uncomfortable reality. Inflation didn't truly disappear. It just slowed down. Prices didn't fall back to pre-inflation levels. They simply stopped rising as fast. The higher price level became the new normal. Groceries cost more. Rent costs more. Insurance costs more. Healthcare costs more. Services remain sticky and expensive. So when officials say inflation is cooling, what they really mean is that the rate of increase slowed, not that purchasing power was restored. And purchasing power, once lost, rarely comes back. This matters because if the Fed eventually cuts rates to support growth, inflation pressures could easily return. So policymakers are stuck between protecting growth and protecting currency value. And historically, growth usually wins politically. That often leads to easier money again. Why silver isn't just gold's little brother. Now let's talk specifically about silver, because many investors misunderstand its role. Silver isn't simply a cheaper version of gold. It actually plays two roles at the same time. First, it's a monetary metal like gold. For thousands of years, silver functioned as money and a store of value. It still reacts strongly to inflation expectations, currency confidence, and real interest rates. But silver also has a second personality. It's an industrial metal used heavily in modern technology, solar panels, electronics, medical equipment, batteries, and electrification infrastructure. That means demand doesn't just come from investors. It also comes from real manufacturing and technological growth. So silver responds to two powerful forces. Monetary fear pushes investment demand higher. Industrial growth creates real-world consumption demand. That combination is why silver often moves faster than gold during big cycles. But there's a flip side. When liquidity dries up or markets panic, silver can fall harder than gold in the short term. That volatility scares many investors out at the worst moments. Experienced investors understand something important though. Those sharp drops often create opportunities for long-term accumulation. In a world where the Fed is trapped, debt is heavy, and inflation risks linger, volatility isn't just noise. It becomes opportunity for those prepared for it. How these cycles usually end. History shows that when central banks get trapped, events tend to unfold in recognizable stages. First comes denial. Officials insist inflation is temporary and growth remains strong. Then comes stress. Debt servicing hurts. Corporate failures increase. Unemployment rises. Financial cracks appear. Next comes the pivot. Rate cuts, liquidity injections, special programs, and emergency support appear. The narrative shifts from fighting inflation to protecting stability. Finally come consequences. Currency weakens. Commodities and hard assets reprice higher. Cash holders lose purchasing power. Right now, we appear to be somewhere between the denial and stress phases. Officials still talk tough, but underlying economic pressure is growing. And markets are slowly preparing for what comes next. Which brings us to the real question silver investors should ask. What should you actually do with this information? Because understanding the setup is one thing, positioning correctly is another. What smart silver investors do next? So after all of this, the Fed's trap, the debt pressure, sticky inflation, and the signals coming from the bond market, the real question becomes simple. What do you actually do with this information as a silver investor? Because knowing the macro story is useful, but positioning yourself correctly is what ultimately matters. And serious investors don't try to predict every short-term move. They build a framework and let time work in their favor. The first thing experienced investors understand is time horizon. If your view is measured in weeks, silver will frustrate you. It swings violently. It dips when you expect it to rise and rallies when sentiment is still negative. Short-term price moves are unpredictable because markets are driven by liquidity flows, positioning, and emotional reactions. But if your horizon stretches 2, 3, or 5 years out, the question changes. Instead of asking, will silver fall next week? The question becomes, will debt levels, currency pressure, and monetary instability likely be worse a few years from now than they are today? And if the answer is yes, then periods where silver trades quietly or even drops become opportunities rather than problems. Because long-term investors accumulate during boredom and pessimism, not during headlines and hype. Position sizing matters more than timing. Another key principle smart investors follow is position sizing. You never go all in at one price. No matter how confident you feel, markets can stay irrational longer than you expect, and even correct ideas can lose money if timing is wrong. Instead, experienced investors build positions gradually. They buy in stages across time. That way, volatility works for them instead of against them. If silver dips, they add more at better prices. If it rallies, earlier purchases benefit. The goal isn't to catch the exact bottom. The goal is to build exposure before the broader public realizes the opportunity exists. Patience beats prediction. Physical silver versus market exposure investors also choose different ways to gain exposure. Some prefer physical silver, coins and bars, because it removes counterparty risk. It's direct ownership. No financial intermediary standing between you and your asset. Others use ETFs, mining stocks, or futures markets for convenience or leverage. But leverage cuts both ways. When volatility hits, leverage positions get shaken out quickly. Prices can swing violently before the real move begins. Many traders get forced out right before markets turn. So every investor has to balance convenience, leverage, and risk tolerance. There's no single perfect answer, only strategies that match individual goals and discipline. Gold versus silver, which makes more sense? A common debate is whether gold or silver is the smarter play in uncertain times. Gold tends to act as the primary monetary metal. Central banks hold it. Large institutions trust it. During early phases of financial stress, gold often moves first because it represents stability. Silver, on the other hand, is smaller, more volatile, and influenced by both investment demand and industrial use. It often lags gold early, but then moves more aggressively once momentum builds. So gold acts like conservative insurance. Silver acts like a higher volatility version of the same macro story. For many investors, the answer isn't choosing one or the other, but balancing both depending on risk tolerance. Conservative investors lean heavier toward gold. Investors willing to tolerate volatility lean more towards silver for greater upside potential. Why this moment matters right now, and this brings us back to why today's shift matters. It isn't about one bond move or one Fed statement. It's about confirmation that the economic path ahead is narrowing. Bond markets are signaling that high rates won't last forever. Debt math shows governments can't sustain rising interest costs indefinitely. Inflation data shows purchasing power damage hasn't reversed. And quietly, capital is beginning to look for protection outside traditional currency exposure. By the time mainstream headlines openly say the Fed is trapped and hard assets are surging, the easy accumulation phase will already be over. At that point, late buyers chase vertical price moves while early investors simply manage gains. That's why moments before the crowd wakes up are the most valuable. Final thought, so here's the bottom line. The system rarely breaks in one dramatic moment. Pressure builds slowly, decisions compound, and then one day people suddenly realize the exit was always narrow. Silver isn't about getting rich overnight. It's about protecting purchasing power and positioning ahead of monetary shifts that happen every cycle. The Fed will try to stretch stability as long as possible. Markets will swing. Narratives will change. But debt and currency math don't disappear. And investors who follow math instead of headlines tend to survive cycles better than those who chase noise. So the real question isn't whether the Fed is trapped or still in control. The real question is, are you positioned before the crowd figures it out? Because in markets, the reward rarely goes to the loudest voice. It goes to the most prepared. And as always, the smartest investors don't follow narratives. They follow the math.